All right, folks, time to take a look at some problems from Chapter 1. So before you go to watch this video, or you might want to stop it right now, make sure you have this printed out so you can follow along with all the numbers, okay? Again, definitely should be watching these videos, definitely should be taking notes and asking questions, okay? All right, let's take a look at the first one. Okay, so let's take a look. Here they're talking about the statement of retained earnings. It says Stone Culture Corporation was organized January 1, 2020. And for its first 2 years of operations, they give you some information. So they give you, put my pen on here. Okay. So they give you the net income for 2020, the net income for 2021, and then the dividends for 2020 and the dividends for 2021. And they ask you to prepare, based upon what you need, prepare a statement of retained earnings for both years. And remember, 2020 was the first year. So the first thing is what's on the statement of retained earnings, okay? So if you remember, that starts with the beginning retained earnings plus the net income minus any dividends to give you an ending retained earnings. And so 2020, you start with zero, right? Because it's the first year of operation, okay? Now, if you look, they also gave you this asset information here, right? So if you think back to this statement, does it say anything about assets on this statement? The answer to that question is no, okay? So there are no assets here. The assets belong on the balance sheet. So that information, you're like, well, why do they give that to you then, okay? Well, it's to make sure you know what you're doing, okay? It's what's called distractor information. They give you additional information just to make sure you really understand, okay? So let's take a look at how to do this. All right, so the first thing here, notice Stone Culture Corporation, the name of the company, statement of retained earnings, right? What kind of statement? And notice for the year ended December 31st, 2020. Remember, that's a period of time, okay? So, and the other thing, so there's only one statement that's for a point in time, and that's the balance sheet. All other statements are for a period of time, okay? So notice we start with zero. They told you it was first year. They gave you the net income of 40. They gave you the dividends of 15. So your retained earnings at the end of the year is $25,000. Now to let you know, okay, so they made 40,000. Why didn't they give out all 40,000? Well, generally the reason why is that, if you're in business, you can't spend all your money, right? So in this case, what they're looking to do, they're holding on to that money maybe to buy more equipment, maybe to expand by another business. Maybe they're worried about a downturn. Okay, so normally you won't see all the money giving out at dividends. Normally just a percentage of it. Okay. So now for the next year, so this is December 31st, 2020. Let's go to the next year. Same thing, name of the company, same statement of retained earnings. Notice again, for the year ended 2021. Okay, again, period of time. But notice the ending here on December 31st, you have 25. Well, what would you have on January 1st? The same 25, okay? Right? Then they gave you $45,000 in net income. So you add those two together, that's 70. Then you subtract the dividends, which was given information, gives you $50,000. There you go, pretty straightforward, okay? So again, you got to make sure you have the name on there. You got to make sure the type of statement. You got to make sure you have the right period, and make sure you understand what belongs on the statement. Okay. All right. Let's take a look at the next one. Here, Designer Brands. They have fashion shoes on its balance sheet on August 3rd, 2019. First Sunday of the month, August 3rd, 2019. They had these following items in approximate amounts. So they give you all these names right here, right? From here to here, okay? Now, what they do is they give you like a description. And what they want you to do is what is the right name for this item, okay? Okay. Remember, we're making a balance sheet, so assets equal liabilities plus stockholders' equity. So what you have to do is you have to use the proper accounting name. So like here, amounts owed to suppliers. Well, if you owe money to suppliers, it's an account payable. Remember, anything payable and that's a liability. Here it says Designer Brands right to collect on account. That means somebody owes them money. That's an account receivable, and that's an asset. So notice they give the account name commonly used for each of the items. Okay, commonly used. That's what we were doing right there. And then it says, prepare the balance sheet. And then it asked, did they get most of their financing for assets come from creditors? Did they borrow it? Or did they get it from stockholders? Did they get it from selling stock? Okay. And once we do this, we'll be able to answer that question. Okay. So let's take a look. All right. So the first one, accounts owed to suppliers. We said that was account payable and it's a liability. Designer Brands right to collect on account. Accounts receivable. It's an asset. And by the way, you see, by putting these over here, now we know how to put them together. Currency and cash account balances, that's cash, that's an asset. Common stock issued to stockholders, that means they paid for it. That's common stock, that's stockholders' equity. Warehouses, stores, offices, those are all assets. Those are buildings, common name. Merchandise held for sale, it's called inventory. It's another asset. Amounts owed or for promissory notes. Okay, so if you owe money and it's on a note, it's called note payable. Again, another liability. And then accumulated profits for the company. Now, so you got to think, what's the name? Accumulated profits. Retained earnings. Okay? And boom, there you go. So now we're going to go make that balance sheet. Now we're going to go make that balance sheet. Okay, so you start at the top, Designer Brands, right, the name, balance sheet, here's the date, it's in millions. Remember, point in time, okay? Then we start listing up our assets. Our assets, and all you do is go back there and look. We had cash of $75 million. We had accounts receivable, 85. We had inventory of 700,000 or 700 million. We have buildings of this is actually 1.7, because it's in millions. This is 1.7 billion. And again, remember, order of liquidity. Okay. And of all these items, the hardest one, like if you needed money, you'd have to sell your building. Well, you already have cash. You can finance your accounts receivable. Selling inventory is easier than selling buildings. So there's your total assets. Now we go to liabilities that we listed. Okay, we have accounts payable, that's short term, 650. Notes payable, that's 1,180, right? That's in millions. So the total liabilities, right, is right here. Total liabilities is 1830. Okay, so now you could actually check. Okay, you got 2560 in assets, right? 25, and we got 1,830 in liabilities. That tells you that your stockholders' equity better be 730, right? So we go back, common stock 460, and if you're like, well, where did they get that? Let's go right back here. Common stock right there, 460. See, that's why you needed to print this out, right? So you'd have all this information. Okay, we go back over here, 460, retained earnings, 270 for a total of 730. And again, so now you can see your assets right here is equal to your total liabilities plus your stockholders' equity. And there you go, even. Okay. Now they want to know where they get most of their financing from. So they go, how do you know? Well, we got most of the financing. We got accounts payable of 650, and then they got notes payable this versus how much they got from shareholders. See, shareholders here, they got 460, right? And then they got this 270 here. So this, basically the bottom line, this number is higher than this number, okay? So they finance most of it by borrowing money, okay? All right, folks, that's part one for the problems. We'll be back with part two in just a moment.